So we will report back when we get comment from
Yep.
the fine folks at the Bureau of Labor Statistics from the U.S. Department of Labor. Matt, next on the report, do you want to jump to the CBRE
Yes, definitely.
article? Because this is just really, it's really good.
Very similar, and we've been kind of alluding to it throughout our earlier discussion on the CPI, but a lot of good takes in here, and it's they're giving a lot with their takes. They had some predictions earlier in the year, and this one is an update and a review of how successful they were, how far off they were, and if anything's changed about like their fundamental thesis.
There's a little bit of humility in this.
Yeah, it does seem like, and I kind of respect them putting themselves out there, because then they can be proven wrong. And rather than like hiding that, like, oh, it may happen, like, here's it's going to be, we expect just a little more trouble. No, they gave us numbers, and the numbers are either right or wrong.
Well, and who knew?
Yeah.
I mean, what prediction from the beginning of the year or the end of last year for how this year would go would be correct? So it's
but
good.
yeah, I can kind of run through these predictions really quickly. All of them are guided, I think, just like, and I know we discussed this early in the year, their early year predictions were guided by an expectation of a recession that has not come to pass. And this is, and they kind of summarize it here too, saying CBRE has pushed back the timing for a potential recession to late 2023 into Q1 2024, one quarter later than our original forecast. We therefore have extended our forecast for recovery in commercial real estate investment volume and stabilization in cap rates by roughly 1 to 2 quarters, pushing expected improvements into 2024.
Yeah, it is not. I like this format maps. I mean, they're basically saying, so recession, they laid out economy. We thought there was going to be a recession into the 2023, but obviously we don't think it's going to happen. But we're pushing. A lot of this is we're just pushing it out. We're just pushing it down the road. We're just pushing.
Doomsayers, don't worry about it.
Peak interest rates. They basically said that we're going to peak at mid 2023 at around 5%. Well, we're at 5.25 to 5.5, so they're not like too far off.
Oh, it's going to happen. They just say, and what I think a lot of probably cult leaders have said is the apocalypse is still coming. It's just merely rescheduled. So don't worry.
Yeah, end of the world cults always in vogue, especially nowadays. We will now, but looking ahead to interest rate predictions, Matt, and again, like at least even if we don't know, they don't know, but they're at least giving some thought to it and putting a number on it, and they're holding themselves accountable, which we appreciate. They now believe rate decreases will start in 2024, and the Fed funds rate will end the year at 4.5 to 4.75. We also see the 10-year rate ending 2023 at 4%. That's possible in 2024 at around 3.5%. And then again, that's what we were talking about, just a couple minutes ago on looking at these deals today. And you can't be banking on the rates going down. If your business plan is dependent on interest rates falling, you're putting yourself in a trap essentially. But if it works when rates stay high and looks good when rates stay high, or pretty decent, it's not going to look like a blockbuster because you're not getting the leverage. You can't assume that much growth. The interest rates are high. So you're not going to see just blockbuster deals. But what you have to understand is there's this possibility for major upside if rates do come down. Not that they will, but if they do, you can really kick it out of the park, because a lot of these assets, even today, even if like the risk premiums don't make sense relative to other areas of the market, looking at a basis standpoint, the price to build some of these assets is way more than it costs to buy them right now. So like what you hear a lot of brokers saying, and you hear a lot of buyers, and when we're looking at a deal, sometimes we're like, man, on a price per pound, on a price per door, it's a steal. Like, I can't build it for that. Yeah. And we need housing. So tell me why it's a bad idea. It's like, well, it's because you're only going to get 55 or 60% leverage, maybe 65. And the interest rate's going to be 6 plus or minus or plus. And, we can't model that much rent growth. You got negative national rent growth right now. Maybe things will pick up, but it's like you can't be confident unless you're really looking at some comps and you know something. You're not going to push up that much organic than you already know. Yeah. So your returns aren't going to look that sexy if you're reasonable, but you also know there's a big chance for upside. But it just, you can't I think someone who that can't be your base case.
Well, and
it's not even your best case. It's just kind of like, we know this is a possibility, and so where it's interesting, but there's so many variables. Like, you have no idea what that's going to look like. I mean, we've been modeling it, but we don't.
You're saying this from the perspective of like the buying and selling market.
Yeah,
I'm thinking of it. These sellers coming to, if they have loan maturities, they're going to the bank and they don't have as much to come to them with. If it was last year regardless of what the interest rate, if it was last year, it's like, oh yeah, look at all this rent growth, we're great. This year, year over year, they've got steadily declining rents. It's going to be less persuasive in terms of NOI.
Yeah.
I don't know.
No, it's a great point. No, I think everyone was saying because they're reading the CBRE report, or just let's assume for just a moment the CBRE report was general kind of market consensus. That was in the zeitgeist. That's what everyone was thinking and saying was a reasonable assumption, including buyers and bankers. Yeah, like, hey guys, we're gonna wait at least at the end of the year. Let's see what happens. We think you might be able to get some rent growth because you thought you could, and then also we'll see what rates are. We're looking at forecasts showing rates are going to be coming down at the end of 2023, which should work out perfectly for you.
CBRE got rent growth wrong too. CBRE overestimated rent growth, and so it's like a more perfect storm for people that are facing loan maturities than maybe they thought at the very beginning of this year. Like, rates are staying high, rents are staying lower, and
everyone thought rates were going to be low by then. Not everyone. A lot of people said, we think the majority, the consensus was rates will be lower at the end of this year. Rates are like definitely higher.
Yeah.
I mean, end of the year is 3 months away, or less than 3 months away, right? We're in September.
Yeah.
October, November, December.
There's not a lot of room to move here. I'm not sure exactly how many times the Fed is going to have an opportunity to raise or lower rates, or how many meetings there are remaining in the year. But 3 out of 1, even if they lower rates, it's not going that much lower. It's hard to see them.
There's no way. Yeah. The zero. I mean, low digit. Probably they're going to be lowering rates with. I mean, with the current data, like there is no chance that they're going to keep them flat. I don't think they'll raise them. They could.
Yeah.
But I think it's going to be neutral. They're going to hold pat until if they see if there's another month though of like things popping up. Now shelter, which we've talked about a lot, Matt, should really be coming down next month.
Yeah.
That might bring things down, stabilize it.
That's a good point though. If CPI is like it is, even if it does, if it stays where it is, or even just goes down a little bit, it's so much more likely that the Fed would raise than lower at this point. But I think that the upshot to CBRE's whole thing was that no matter if the recession comes, now I called it doom, but they said that the steep downturn is not expected. And everyone complains about the Fed.
There are other predictions, right?
Yeah. So I don't know if it's going to be a recession, and I'm not brave enough to make that call. But I think that ultimately, like these past 6 months, or really 9 months, of operating under different assumptions, the market could have moved much differently. Maybe things, if we knew what was happening in the next 3 months. I don't know. It just, I keep coming back to that idea. Yes, their thesis has changed, or yes, they did not change their thesis and they merely extended it, but extending it in and of itself is a little bit of a changed thesis. Timing is really important to the investment market, but whatever. I kind of want to get into the multifamily specific portion. It's a little bit lower down on I think it's right after industrial.
Yeah.
They do make multifamily. They follow up on their predictions, and I noted one of them, which was their rent growth prediction, initially 3.5, and now they think it's about 2.2. For the following reasons, they say they really are. I don't want to say over justifying, but they're telling us they got it wrong, and here's why. One reason was the lowering of CPI inflation expectations to 3.7 from 4.0 for the year, which will have a 1-for-1 downward effect on normal rent growth projections. Second is a downgrade to their employment outlook. And the third is significant deviations from earlier expectations in quarterly data for numerous markets. I think that fourth one's like, the data. But their employment comment is interesting because I thought that part of their assumptions of recession earlier in the year were associated with employment, or at least that it would either cause unemployment or be, the linchpin of the recession definition. So I'm not really sure how their downgraded unemployment works out here. But regardless, They did adjust their expectations, I think, pretty accurately. And they also adjusted their expectations for supply and demand. Supply, most notably, they went from expecting, now this is just projections, their expected supply numbers were around 300,000, and they changed it to like 450.
Yeah.
I'm sorry. It was, expects 350 units to be completed in early, and then 450,000 is what they now expect. Seems like the supply things are getting unclogged, or whatever snarls used to be.
And for so many, now we saw estimates of 500 and 600,000 at some point also. Those have all gone away. Probably some of those projects got, I don't know, got canceled. Usually we under-deliver a little bit. In the past couple of years, at least, we've under-delivered what we've expected, and so this is a different case. But I think it's also the essence of moving around so much.
A lot of them seem to be around 400,000, which is still like really great and like amazing numbers. But it's not, not the huge numbers that are still in the pipeline right now.
No, we were doing around 300,000 a couple of years ago, and that was like considered, very, pretty healthy.
Yeah.
So, and again, we were digging out of a deficit of lack of construction.
Yeah.
So.
And, earlier in the year, and I'm not sure if the number's the same, but there were about 1 million units under construction, at some point. So, a lot of those could shake out.